If you watched gold and silver tumble fast, it felt like the floor vanished without warning. That shock is the point, because the real story often hides in the paper layer of metals. Most people picture bars and vaults, but price is set where claims trade, not where trucks move. In institutional hubs, much of the volume is unallocated, meaning your metal is a ledger entry, not a bar. A ledger entry is convenient, but it is also a liability, so banks hedge it through futures, swaps, and options. When stress rises, banks shrink balance sheets, and those hedges get tightened or unwound with speed. That balance sheet squeeze can hit metals even if nobody touched a physical bar during the whole session. This is why supply headlines can stay bullish while the trading screen prints a sharp, sudden drop. It also explains why the slide often begins in the deepest hours, when paper can move in heavy size. Once price cracks widely watched levels, chart-focused traders react, and the move gains another engine. Some players are not trading metal at all. They are trading volatility, correlations, and portfolio risk. Metals become a dial inside a larger book, turned down when managers need to calm overall exposure, even if bullish long-term. And when that dial turns down everywhere at once, the market reads it as panic instead of routine control. The scary part is how quiet it looks beforehand, because paper leverage hides behind smooth, stable charts. Then a clear catalyst, like a rate shock or a crowded options expiry, lights the fuse and starts the chain. The mechanism is simple in spirit, brutal in practice. Leveraged paper gets forced to sell. When pressure hits, the paper market can dump metal exposure faster than physical can respond. Here is the uncomfortable truth. The initial sellers may not be bearish, they may be trapped. Metals futures let big players control huge value with a small slice of cash called margin. That leverage works like a magnifier, making small moves feel big and big moves feel fatal. Now imagine volatility jumps, and exchanges raise margin demands to protect themselves. Suddenly, traders must post more cash right now, or their positions get cut automatically. Cash is not infinite, so they sell what they can, not what they want, to meet the call. That selling pushes prices down, which triggers more calls, and the spiral feeds itself. This is why drops can look disconnected from jewelry demand, miners, or central bank buying. The paper side can create a stampede even when the physical side is steady or even tight. To see it clearly, follow the plumbing, not the headlines, and watch who must act next. Large funds often run systematic rules that reduce risk when moves accelerate downward. When the trend flips, these systems sell futures by design, adding fuel to forced selling. At the same time, banks and dealers hedge options exposure to stay neutral as price moves. When price falls, hedges can require more selling, creating a feedback loop called gamma. That loop can turn a normal pullback into a slide that feels coordinated and unnatural. Then come the spread traders, who link futures, spot, and swaps across different venues. They watch the basis, the gap between paper prices and cash prices, and they act fast when it distorts. When futures drop faster than spot, arbitrage can demand selling in a venue to buy in another. But during stress, liquidity thins, so executing that trade can worsen the move instead of calming it. Liquidity is not a mood. It is a set of bids and offers, and those bids can disappear in seconds. When bids vanish, even modest sell orders can punch the price down like a trapped door in a heartbeat. That gap invites more sellers because everyone sees the same falling tape and fears being last. Fear is rational when leverage is involved because forced exits ignore your long-term thesis. Now add another layer. Many investors hold metals through ETFs, not coins or bars, and flows can flip fast. ETF shares trade like stocks, but the fund must match shares to metal through authorized players. When investors rush out, shares are redeemed, and the authorized players unwind hedges and futures. That hedge unwind often means selling paper metal immediately, while physical adjustments lag behind. So the screen price can drop hard, even if the vault inventory changes more slowly and physical stays firm. This is why you might hear that physical premiums rise while the headline price falls. It sounds like a paradox until you realize separate clocks are running at different speeds. The paper clock can sprint, the physical clock walks, and the sprint sets the public price. Add a strong dollar day, rising real yields, or a risk-off shock, and metal becomes a funding source. Funds sell what is liquid to raise cash, and metals futures are extremely liquid until they are not. In that moment, gold and silver get treated like a button you can press for instant dollars. And when everyone presses the same button, the platform glitches, spreads widen, and stops trigger. Stop orders feel protective, but in a vacuum they become market sells and the chart turns into a cliff. Here is where the mechanism feels personal, because it punishes anyone who is late to react. Even disciplined investors can get shaken out when they see red candles stack relentlessly. The market knows that, and liquidity providers step back when they smell forced flow, so spreads widen hard. They do not want to catch a falling knife, so they demand a bigger discount to take the other side. That bigger discount becomes the next lower price, and the process repeats with less resistance. Notice what we did not need in this story. A sudden collapse in real-world metal use to kick off the plunge. We did not need miners dumping supply or consumers refusing to buy or vaults overflowing. We only needed leverage, margin pressure, and a chain of risk controls firing in sequence. Once you see that chain, you can spot the early signs before the drop becomes dramatic. Watch volatility measures, because rising volatility can precede margin hikes and de-risking. Watch futures open interest and positioning reports, because crowded trades unwind violently. Watch options activity, because heavy put buying can shift dealer hedging into sell mode. Watch the basis and the swap spreads, because stress shows up as distortions in those links. Watch order book depth, because a thin book turns normal selling into an air pocket before anyone can react. And watch the calendar, because roll periods can concentrate flow as contracts shift forward. When these signals line up, the paper side becomes a machine that sells immediately and explains later. The move is not automatically fake or manipulated, but the paper mechanism can amplify speed and damage. Like dry brush in a forest, a small spark can spread fast. Price is a story of constraints, not beliefs. In a crunch, the binding constraint is cash, collateral, and risk limits, not sentiment alone. So if you hold metals as protection, you must accept that protection can dip when cash is king. That dip is not proof the thesis is wrong. It can be evidence the hedge is being harvested for liquidity. But you should plan for it, because surprise is what turns a drawdown into a bad decision under stress. Planning means sizing positions, so margin calls cannot force your hand at the worst moment. It means avoiding overconfidence when charts look calm, because calm often precedes a volatility spike. It means understanding what you own, especially if it is an ETF or a leveraged derivative. In stress, paper claims trade at algorithm speed, while physical metal moves with logistics and trust. Over time, those speeds tend to converge, but in the short run, they can violently diverge. This is why sudden sell-offs can reverse quickly once forced selling finishes and liquidity returns. When the mechanical sellers are done, price can snap back, and the headlines scramble for a new narrative. So the next time metals drop out of nowhere, ask a different question than most people ask. Ask who needed cash today, who faced a margin call, and who had a rule that forced a sale. That question turns chaos into a map, and the map gives you a calmer, smarter response. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game. Finally, remember that the paper side sets the print, but the physical side sets the long game.